Hey guys, welcome to Market Monday. So I'm gonna give you guys a quick update on everything that happened last week and what's expected to come this week. Before I get right into it, I'm gonna do a quick dad joke. Dad joke today is, why don't cannibals like instant noodles? Why don't cannibals eat instant ramen? It's because they like raw men. Raw men. Get it? Pew, pew, pew. All right. So getting right into it. Last week we got it's a pretty solid good week in regards to how mortgage rates interacted. For the most part, we did see some slight improvements throughout the week. The main big improvement that we saw, which I was expecting, was the PCE inflation report, which actually came in better. It actually improved, and a whole bunch of others not came in better, and also as expected. So that was really nice seeing that inflation report showing improvements in that specific inflation levels, which we kind of saw here. Now we're seeing the same levels we saw back near September of last year. So we're now going toward a lot closer toward the Fed's target of that 2% number. And then in addition to that, mortgage rates did also improve a little bit because of this PCE inflation report. So overall, things are heading in that direction in a really solid way. Another report that came out is something called the Case-Shiller Home Price Index to kind of give an idea of how home prices are doing on an average scale. So month to month, home prices kind of went down a little bit, really small amount, right? But if you look at the year over year, and I've talked about this multiple times before, if you guys been listening to these videos, is that we're back down to normal levels. Okay. Back in 2019, 2020, 2021, and even in the beginnings of 2022, we saw crazy double-digit appreciation numbers that were over 5, 7, 8, 9, 10% appreciation every single year between 2019 and 2022. So if you think about it, that's really unsustainable. Now, it's great for owners to have so much appreciation every year. So imagine every year if you own a $500,000 house, if you saw 10% appreciation for 4 years, that's making 50 grand every single year. So you could also, in about 2 or 3 years, you're walking away with at least $100,000 on the sale of your house under 3 years. That's crazy. So, and again, home prices being at those levels, at that level of appreciation is extremely unsustainable. So it's nice to see like these numbers are coming back down to the average national average between 3 to 5%. This is what normal numbers are supposed to look like as each month goes on. Yes, the reason and most of the reason why home prices are going down for the most part isn't because home values are lower. It has to do with more of there's not enough transactions that are happening. So that's kind of what it's looking at. Now, this isn't saying that home prices are going down. It just means appreciation isn't going up as high. So for example, you bought a house this year for $100,000. Next year, you earn 4% on the value of the house. So now your house is 104. And then the next year goes to 3%. Now that house is worth maybe 108 next year. It means that your home appreciation is still in existence. It's just not going as high as it was in the same percentage previous year. So there's still appreciation that's happening. It's just significantly slowed down to the levels that are normal. So we were really high for a long time. Now it's back down to normal levels. Now it's way more sustainable for people who are where the wages and the income hasn't caught up quite yet, is because home prices just shot up too fast. That's the main thing. It just shot up too fast for too long. It spent 3 or 4 years in the 10% range. So now it's nice to see home prices slowing down. It's not that home prices are going down, they're just slowed down. Keyword. So I'm still, instead of running 100 miles per hour, I'm running 85 miles per hour. I'm not going backwards, I'm just going a little slower. That's all it is. So that's good to see that home appreciation still exists. And in a level that is a lot lower. The next thing I want to show you guys is how mortgage rates had done last week. So if we're looking at the span of last week, it's pretty much right here. We did see the mortgage rates did improve by a little bit, and most likely it hit this bottom peak here because of that PCE inflation report. So we saw steps of it coming down, and then it added on top of it with that PCE inflation report that came out last Friday. So that's a good sign. Things for the most part, and if you look at the scope of things, it's pretty much flat. If you think about it, we're still in the 6 to 6.5 range, at least for VA rates. So it's not terrible. Things haven't been as volatile as they've been in the last 3 years prior. So I'm really excited to see those numbers. The one big thing that's coming out this week is the jobs report. Now, to give you guys an idea of how the jobs market is doing. So initial jobless claims, these are people filing for unemployment for the first time. This went up by 14,000 and now we see it at 240,000 people who have filed for initial jobless claims. So unemployment. However, the continuing claims have gone up 26,000 people. So what that means is that of the people who already initially filed for unemployment, they've continued to file for unemployment, and that number has risen by 26,000 last month. And now we're at a total of 1.91 million people who are now who are still unemployed and continue to file for unemployment. So with this number has gone up quite a bit. It's been up above 1.8 by a long time. So this is kind of the tough thing to see, that the unemployment rate is expected to go up, right? So if we look at this week with the jobs reports that are coming out this week, we do expect those numbers to show that the labor market is continuing to weaken. And if that's the case, we might see another positive improvement for mortgage rates this week as well. So we'll see how this goes in regards to that. And again, sometimes these reports are showing different numbers. Another thing that kind of shows the slowness of the economy is GDP. GDP is gross domestic product. It just basically monitors the amount of sales and the things that people are basically buying, retail sales and things like that. So are people buying? And that's what's that showing, is that GDP is slowing down. Like there's a negative GDP. So if there's another quarter of GDP, then we might be looking at another potential recession indicator. So hopefully that helps you guys understand what's about to happen in the short term and the long term. I think with the unemployment rate going further into showing more weakness, we will see mortgage rates start to improve more and more. So we'll see how this all goes, but we're starting to see signs of the economy breaking, and if it continues to break, then we will see all of it happen in terms of mortgage rates. So otherwise, that's all I got for you guys today. Hopefully you guys got some information, some insight out of this. That's all I got. Nuke out.